How do lenders assess risk for loan terms? Imagine you're about to lend money to a friend. You want to be sure they'll pay you back on time, right? Banks and credit unions do the same thing, but on a much bigger scale. They have a detailed process to figure out how risky it is to lend to someone. This process helps decide the loan's interest rate, how long the borrower has to pay it back, and what kind of collateral might be needed. First, they look at credit scores. These are numbers that show how well someone has managed borrowing in the past. They consider things like whether bills were paid on time, how much of the available credit is used, how long the person has been borrowing, and what types of credit they have. These scores, like FICO or Vantage Score, give a quick estimate of how likely someone is to default. Next, lenders analyze financial documents. They check bank statements, income, expenses, and debt levels. They calculate ratios like debt to income, which compares how much money someone earns to how much they owe. If the debt-to-income ratio is too high, it suggests the person might struggle to make payments. Lenders also use advanced models that look at past data and economic trends. These models predict how likely someone is to default based on many factors. They measure the probability of default, which is the chance the borrower will not pay back the loan. They also estimate how much money they could lose if the borrower defaults, called exposure at default, and how much they might recover if they sell collateral, known as loss given default. For business loans, lenders check the experience and skills of the management team. Strong management can lower the risk because they are more likely to run the business well and make payments. Collateral is another key factor. If the borrower offers assets like property or equipment, the lender can sell those if payments are missed to recover some of the money. The value and liquidity of the collateral matter a lot. Lenders also assign risk ratings to each loan. These ratings help them keep track of which loans are safer and which are riskier. They group loans by types, like personal or business, and monitor them regularly. If the risk profile changes, they can adjust the loan terms or take action to protect themselves. They follow strict policies for lending, including rules about how long the loan can be, how much collateral is needed, and whether a guarantor is required. These policies ensure consistent risk evaluation. They also review loans periodically to see if anything has changed. If a borrower's financial situation worsens or the economy shifts, they might change the risk rating or adjust the loan terms. All these steps help lenders set fair and safe loan terms. Riskier borrowers might face higher interest rates or shorter repayment periods. Those with good credit and solid finances usually get lower rates and more flexible terms. This careful process helps banks and credit unions lend responsibly while supporting their growth.